10-year note yields remain stubbornly low, not just today and not just yesterday, and not just when we were talking about the Fed possibly cutting rates and the Fed actually coming out and saying that they're going to be willing to consider cutting rates. 10-year note yields have been on a decline. You go back to March FOMC, that's when the speed of the decline started to pick up, but it really goes back to the end of the year and actually in the fourth quarter of 2018 when we started to see yields turn. And we saw them turn in the 10-year all the way down to where they are now, and that's right above 2%. And some are looking at that as really the key level. Can the market get through 2%, or will sellers emerge and we will start to see yields creep back higher with the idea that now the Fed has told us what they're going to do and maybe it won't be as dovish as possible? Well, I take a step back and say 2% isn't the level. It is a level to look at, but really 185 is the level you want to look at in 10-year note yields. That is the level we launched at in November 8th of 2016 on President Trump's election victory. The market was trading around 185. We've seen it rise all the way up to 3.25 and now back down to 2%. And if we can get back to 185, it's probably it's the retracement of that entire journey we've made over these last 2+ years. And I think at that point, we'll have to kind of weather how the Fed is going to act, where the economy is, and whether or not yields are going to continue to go down because of demand or because of fear or both. And I think at this point that key 2% level, while it is important, it is more of a psychological level than that of a technical level. And if you look at market volatility, in the Treasury marketplace, it is higher. Certainly got hit today, but historically, from what we've seen over the last several years, we remain elevated. And that's because there is still concern. How is the Fed going to make all this happen? Where is the economy going? And the urgency to cut kind of tells you that while there is global effects on what Fed policy may be looking at, and financial market stability is another, perhaps domestic economics are also playing a hand in this. And I think at this point, volatility being elevated is probably the right way to look at this. I think if vols were going down like we're seeing in equity markets, there would be considered a disconnect. And if you look at the equity market vol, it's non-existent. And when you look at Treasury vol, it's very high. So a big disconnect between those two asset classes. And lastly, let's look what happened today with the Fed. Well, they did not cut rates, which was expected, but they will be cutting rates according to the market in July and again in September, and likely again after that in December. A lot can change over the months in those meetings, but certainly the Fed made clear their willingness to cut, something that the market's been telling us for quite some time. So the Fed, again, we talk about whether it's going to be the Fed shifting towards the market or the market shifting towards the Fed. This is a clear example. Fed having to shift towards the market. And I think at this point, they're going to continue to shift towards the market. And when we get through July FOMC and we get through September FOMC, and then we can reassess whether more cuts are necessary or if more cuts are even working, I think at this point it has yet to be seen. But the market's really pricing in 75 basis points of cuts in 2019. And right now, we really only see two clear instances of when that could happen. So December is probably going to be an outlier wild card. That would be the meeting, I think, where we get that third rate cut. At this point, though, a lot of uncertainty and a lot of Fed discussions have to be had before we can get there. So 10-year note yields hovering at 2%, not the key level I'm looking at, 185, which is a little bit further lower, but certainly would retrace that beginning of the Trump presidency to where we are now and likely would create a whole lot more uncertainty if we were to go south of that level.